On the carbon side of things, it continues to be the case that the U.S. is the premium market with regards to demand and with regards to pricing. That's a bit of a good news, bad news situation because as we sit here right now, U.S. prices are really more than double some other regions of the world. We're currently sitting right around $1,100 per short ton for hot roll. That's up from $650, so call it 500, roughly $500, 450, $500 since late September, early October that we're up. So that's a pretty dramatic move. You can see in comparison to Europe, which is shown in the blue line, China, which is shown in the orange line, they've seen a little bit of inflation. They've seen a little bit of an inflection higher in prices, but their move is 10 or 15%. Here in the US, it's almost 100% in the last couple of months. So what's driving that? Well, one is certainly I think we can make the argument that the United States is a premium market with regards to how well we've held up relative to some other developed market economies. You look at Europe, for example, you think about those PMIs. That was the big sliver of red going straight through the screen. So things are pretty soft within Europe right now. I would argue very much so that they are looking like they are in recessionary territory. So it makes sense that their pricing would be at some semblance of a discount to ours. Other factors we've got going on is the U.S. mills, the steel mills, they are keeping production of steel relatively subdued. This is looking at the capacity utilization rate. So this is of the productive assets that are available here within America, what percentage are being utilized to make steel. And you can see that the latest number is 73.1, which is a pretty soft number, particularly when you consider the fact that steel prices are up $450, $500 in the last 3-4 months. I would have thought, and maybe the mills are just trying to prove me wrong, but I would have thought that in the face of $1,100 hot roll, we would see steel mills attempting to capitalize on that and become far more profitable by meeting the higher prices with more production. But we just aren't seeing that at this stage. So whether you call it artificial, whether you call it gamesmanship, whatever, or you just call it good business, the mills are being very responsible with how they are producing steel into this current market. So they're keeping things a little tighter than what many, I think, would have forecasted, given the fact that we have $1,100 steel. The other thing we've got, and unfortunately this data is a little stale because U.S. Census Bureau data tends to be very lagged. So the latest data that we have is as of October. But what we're looking at here is carbon imports of a variety of carbon products. You can see them color-coded down at the bottom. Ultimately, what the point of this is one of the big things that allowed domestic mills the opportunity to hike prices as many times as they did over the last several months. The market was tight. They were producing at a very low level, 73% utilization rates, and imports for the last several months have been very subdued. So that makes for a somewhat tight market potentially, or I guess particularly when you consider the fact that I think there were a lot of service centers and end users that stockpiled material back in September, October, November to kind of try and get out ahead of the potential price move and to get out ahead of Q1, which is typically a seasonally strong time. So you had this combination of factors of low imports, low utilization rates, probably some stockpiling taking place, and that allowed for this storm to take place. If we fast forward on these import data points, I would suspect that as we roll into November, December, January, February import data, I'm going to guess that these bar charts move higher and higher and higher pretty quickly, because while imports were not attractive 3-4 months ago, back when these data sets would have been formed, the imports are advantaged at this present time with domestic pricing at $1,100. Imports are sure to be somewhat cheaper and potentially compelling to bring into the United States, so that people can have a mix of inventory that makes it a little bit cheaper.
The scenario you outlined earlier in the Red Sea counter that.
Yeah, I'd say it throws a small wrench into it. It would increase the cost of those imports slightly, I would argue. It could have a small impact on that for sure. And then lastly, the one thing that I didn't touch on was there is absolutely, and the mills will tell you this if you ask them, there is a raw material inflation that's taken place over the last couple of months. The white line is going to be busheling scrap. It's gone from about, let's say, $400 up to $550. price of iron ore has gone from about $100 to 140. So those are meaningful moves, without a doubt. Are they meaningful enough moves? Is scrap going from 400 to 550? Is that enough to substantiate steel going from 650 to 1100? No, not at all. Not in any world does that fully get substantiated. But when you factor that along with the fact that markets were exceptionally tight due to lower production levels, utilization rates, lower imports, and a bit of stockpiling, yeah, I think that creates the storm you can get. The issue that we may have as we roll through time, and this may look pretty familiar or similar to what we saw in 2023, there is a risk that this, and the market currently thinks that this party or this inflation of steel prices won't last all that long. You can see that in the shape of the futures curve, which is basically the market's expectation of where prices will go in the future. Otherwise, if it's wrong, you can buy these contracts. If you think it's too high, you can sell these contracts. So these are moving around every single day. This is just the snapshot as of last night's close. But you can see for the next 2 months, the market is basically saying they think prices will be elevated somewhere around 1100, maybe a little bit above 1100. But beyond that, at least as of today, the expectation is each month in time we roll forward, we may see $100-ish price moves lower as some of these factors correct themselves. And I would say you probably also get a little bit of a seasonal weaker time period beyond Q1. One thing that I didn't mention already is earlier this week, it is worth noting that Cliffs, they did do another price hike. So they took the base price of their carbon shipments up to $11.50 for their base pricing for hot roll. I haven't seen yet if any other mills have followed suit. Not that necessarily matters all that much, but it is worth noting, at least as an anecdote, that one mill thinks that the prices deserve to be a little higher than where they are right now, which is right around 1,100 bucks.